Yeah, we were just hearing that the ECB is more or less done when it comes to the rate cutting cycle. At least that's what one of your board member, governing council members was just saying. But I would like to start with you with that policy or the strategic review you presented yesterday, and also with the implications for monetary policy setting. What will be the implication for the next July meeting?
So I can tell you the implication for July is zero. This is a 5-year strategy. We said this strategy would take us from now until 2030. So we looked ahead, and when we looked ahead, we made the assessment that actually this is going to be maybe a lively 5 years. We have geopolitics, we have AI, we have the demographic transition, we have the green transition, we have changes in the international financial system. And when we look at this, we concluded essentially that this could be a 5-year period where inflation's more uncertain. We will have many debates about are we seeing a significant move in inflation or a transitory move, and more volatile, because the nature of these shocks is maybe they can be genuine surprises, but they may not essentially all be in the same direction. So what we concluded was a two-sided risk to our target, uncertainty, and the implication for monetary policy is maybe very much validating what we've said for a long time now. You need to be very data dependent, you need to be meeting by meeting, and in this environment it's not very helpful to provide much forward guidance, because the world can change in a space of a few weeks.
But in a way, you're saying that there are more shocks ahead in the next coming years because of all these factors you were mentioning. But how can you react as a central bank to like immediate shocks, because it has a certain time lag, yeah?
No, exactly. So again, we've tried to emphasize that essentially blips we're not going to respond to. And so our challenge will be, when is a movement in inflation more than a blip? When is it something that may be in the system for a while? And if it's in the system for a while, then we would have to respond. Because if inflation goes too high or too low, if that causes people to change their beliefs about the long term, if it causes them to believe, well, actually now, because the central bank is not responding, I think inflation is going to settle down at 3% or 1%. We really don't want that. We want the 2% target. So monetary policy will be there to respond to that. So as you started at the start, we do think the last cycle is done. So bringing inflation down from the peak of 10 back to 2%, that element is over. But on a forward-looking basis, we do have to stand ready to make sure that any deviation we see does not become embedded, does not change the medium-term picture.
Yeah, one element, of course, of uncertainties are the tariffs and what happens to a trade deal in the euro area. So what's your best assumption, and what will it mean for your monetary policy setting?
So we did look at this quite a bit in June, and we did look at different scenarios. So our baseline is essentially that the 10% tariff that the US administration has in mind as essentially as a universal baseline, that is part of our baseline, that will happen, and maybe some sectoral action as well. But we also looked at the more severe tariff scenario, and we also, I think, it's important to look at the benign scenario, where essentially we go back to the world we were in, of essentially much freer trade. So I think what's important is there is variation in terms of GDP. So the European economy, the world economy, there's a significant re-engineering, if you like, if there were significant and permanent tariffs in place. So for GDP, there's we do think it's to the downside. For inflation, there's forces in opposite directions. So if you look at our published scenarios in June, there's not a huge amount of variation in inflation. So we will be keeping an eye on this. I mean, everywhere in the world, people are asking, okay, on the one side, if I'm an importer, if I have some crucial input, if my supply chain gets more expensive, that's going to push up cost. On the other hand, in this environment with a lot of uncertainty, people's willingness to consume, firms' willingness to invest is compromised. So there is a deflationary demand side. And this is why the data dependence philosophy is important.
Yeah.
Rather than take a big kind of position today, July 1, that I know for sure which of these forces will dominate, we'll be tracking the data.
I would like to bring you back to your comment that you're done with the rate cutting cycle. Is it done? Or
no, what I'm saying to you, and I think this is a very important interpretation, is in relation to the shock of 2021-22,
okay.
that we think we've managed to get out of the system. So right now we're around the target. Of course, we'll have the June number very soon, but it looks like we're around the target. So what we're focused on now, and the June forecast is focused on, is not that. It's we've seen a big movement in energy prices this year, a big movement in the exchange rate, and that has led the forecast for next year to be 1.6 as of June. I'm not saying that's the best number right now. Let's see what we have later on. So there's already new shocks hitting the system, and our monetary policy in relation to those new shocks will adapt to how those evolve. So again, market pricing essentially thinks we're now in a cyclical phase. There might be some cyclical movements a bit lower, but because they're cyclical movements, the market also thinks they will be reversed, in a year or two. So there is a gear shift in the debate. It's not about a big, gigantic shock. It's essentially more forward-looking, more kind of trying to anticipate the implications of what we're seeing in energy markets and in the exchange rate, and to make sure that we don't overreact to kind of small deviations, but equally we don't ignore the implications for medium-term inflation if there were persistent movements in those factors or in the domestic economy.
I think one big surprise this year was the appreciation of the euro. You have been referring to that as well. And with that comes some sort of tectonic shifts, if you like, in the financial system. Europe has gained much more attractiveness. Do you think that is here to stay?
Well, I think the safest interpretation is indeed what we've seen so far is essentially a level shift. There was a kind of very high conviction, and also the capital flows reflected that, to have a very large over-allocation to the US. What's happened now is that it's retraced. The US is still, of course, a very important investment destination, but there is some rebalancing by European investors especially, but also global investors towards the euro. And I think what we've seen so far looks durable, but of course we're very interested to see what happens next.
What are the implications from that for your monetary policy?
Well, I think we will have to look at it from different perspectives. I mean, in the bond market, essentially, if it means that term premia are lower, and as you know, if you look at the 10-year rate in the euro and so on, and further out, we've not seen the upward pressure we've seen in some other parts of the world economy. So that has, if you like, an easing effect. On the other hand, the appreciation of the euro has a tightening effect. So the net effect on monetary policy we will have to kind of keep working on. But essentially, I would say I'm looking at the bond market and I'm looking at the FX market.
Essentially, but that move as well of money flows has as well led to the debate that the euro could have a true global moment. And you've been arguing that we need more safe assets, if that's the case. Perhaps you can enlighten us what you mean.
So essentially, the euro area has a very large GDP, but because of the fact we have 20 member countries rather than any kind of significant European-wide treasury, what's ended up is the amount of kind of first-rank bonds, if you like, is small compared to, say, what the US can offer. So when a global investor is looking at Europe, the kind of set of the highest rank, the most liquid securities is not as big as it should be. So what I said a couple of weeks ago is essentially we should go back and look at these proposals, such as one called blue bond, red bond, which basically says if the European member countries act together with some more pooling of tax revenue, not necessarily a huge pooling of tax revenue, but more than we have now, that would allow, for example, maybe 25% of GDP to be in circulation in terms of, if you like, European level highly liquid assets. And that's a collective decision for the member states, because there is a price. The price is you do have to ring fence a certain amount of tax revenue to back those securities. But from the point of view of having a bigger pool, a shared pool of highly desirable government securities that the world would like to hold, that is an opportunity.
You think there's enough political will for that?
Well, I'm not going to try and predict how the member states will think about it, but I think from my technical advice, if you like, is when we look at this, and other people have looked at it, this is something, if they were willing to ring fence tax revenue along those lines, I think it would be popular among investors. It would lead to, if you like, a greater convenience yield offered by the EU area, and that's a collective win for Europe.
Critics do argue there's enough safe assets around, but they're all sitting on your balance sheet. You could sell some of them as well. Why don't you think about more quantitative tightening?
Well, I think anyone who looks at this knows that the best strategy for the ECB is to do what we're doing. Let these roll off passively. There's now the scarcity that was there is not there. And so I think it's important for us to do our job, and for the wider debate about the European architecture. I mean, this debate, the point I made, holds regardless of the size of the ECB balance sheet. And it's important not to confuse monetary and fiscal. And so the point I'm making here is, in terms of the European bond market, there are innovations, again, in the hands of the member states and the Commission, to look at that as a collective enterprise.
Let's speak a bit about the fiscal space and the fiscal stimulus, especially the one coming from Germany, because I think you've mentioned that in one press conference, I think it was the one before the last, as one of the reasons why you think inflation could actually be higher in the medium term. Is that the case?
So I think if you go back, and actually I remember June 2019, which is the first Sintra for me when I came in as chief economist, part of the debate there was how can we generate 2% inflation when European fiscal deficits were around 1%. Now what we see for the next few years is the collective European deficit being 3-something. And so what I would say is it makes our 2% target more credible. That there'll be a significant support from fiscal spending. And of course, we can adjust our interest rate to match. But the kind of scenario where fiscal policy is too negative on demand, pushing inflation below the target, pushing us back to the lower band, that scenario, I think, is clearly less likely. Now we have this essentially significant move in fiscal policy. But like as always, and if you go back over history, the central bank can respond as it sees the net impact of fiscal policy on demand and on the economy. And with public investment, because part of this is improving infrastructure spending, over the longer term, if you improve the productive capacity of the economy, that has anti-inflationary elements as well. In the near term, we'll have more demand. Longer term, I hope more supply capacity, and the central bank can navigate that.